I have constant emails and messages coming to me. Hey, I heard if I buried my grandma in the backyard, I never have to pay real estate taxes again. Is that true, Nate? I'm like, okay, here we go. Let's peel the layers of the onion.
Wealth Without Wall Street Tribe, excited to bring to you Dr. Nate Salah in the house. Nate, so glad to have you.
Glad to be here.
Nate, you're a man of many talents. The one that I want to lean on today is that the tax wisdom that you possess. As investors, entrepreneurs, we are constantly out there trying to make more money, and we need people like you in our corner to help us keep more of that money.
That's right.
And 30 years of doing tax planning, running an amazing business there in Missouri, which is pretty close to the Virginia area, from what I've heard, is there's things that you've learned that we need to know. Give us a little bit of a background as things that we could start this conversation off in the tax preparing world that most people make the mistakes of not learning before they delve into it.
Yeah, no doubt. Yeah, great conversation around taxes, and it never gets old. We as business leaders, taxes are constantly changing with every administration. And at the recording of this, we have a brand new administration as of yesterday, brand new old administration, I guess you could say. And so lots of question marks around, okay, how's this going to affect me as a investor, as someone who wants to protect my money? What we sometimes forget, and just like taking a couple steps back, one of the reasons why this conversation is so important, so relevant. When I got into tax work back in 1995, it was complicated, but it's even more complicated today. And one of the challenges we face as business leaders and investors is, taxes, we know it's important, we know it hurts, but since it's not on an income statement or a balance sheet, we can't really see the impact of that. But rest assured, most people listening, somewhere in the neighborhood of 15, 20, 25, 30, even up to 40+% of your income is being moved into the bucket of an expense called taxes. And we just don't see the bucket because it's not on our financials, but it's there, right? It's real. It's real. And when do we feel it? We feel it when we go to perform our obligatory pilgrimage every year, whether it's in March, April, October, to get our taxes done. And many of us write a check, right? So if you're successful in business and you've got assets that are earning you money, oftentimes you're writing a check either throughout the year for an estimated payment, or you're writing a check during tax season, right? And so that can be a good thing, but we don't want to write any bigger check than what we're legally required. In fact, our vision statement as a company is that we want to promote a thriving community of taxpayers who pay the government not one red cent more than legally required. Yeah, that's music to the ears, right?
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we were able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before. Go to whatswhatwallstreet.com/PIOS.
Well, I know there's a big difference between tax evasion and tax avoidance, and we want to stay on the right side of that. But as to your point, I don't think it makes us more American to pay more in taxes, and that's a mistake that some people make. True.
Indeed, yeah, and so that's why we insert the word legally. That's critical. We want to work with ethics and reason and with the moral intentionality. And I know we're all people of not only faith in terms of doing the right thing for the right reasons. We also want to, we want to be, I don't know how I would say it, not only savvy, but shrewd. Shrewd's a good word, right? We want to do our homework, and that shrewdness is essential. in terms of navigating this complicated world, and especially with social media now. So I'm sure your viewer or listener has popped on social, whether it was an Instagram post or now TikTok was gone and now it's back. And all these, we call them tax schemes, right? All these schemes. I have constant emails and messages coming to me. Hey, I heard if I buried my grandma in the backyard, I never have to pay real estate taxes again. Is that true, Nate? I'm like, okay, here we go. Let's peel the layers of the onion and see where it can stick. Truth is, in most of the posts or the reels that we see, the 30-second or a minute and 30 blurbs on some of the tax advice, and we'll unpack some of them here today. There's some truth to them. However, they can be very dangerous because if we attempt to implement or kick a can down the road with a strategy that's not implemented in compliance with IRS code, that's not done with the proper documentation or support, then we could fall under not just scrutiny, but we could fall under penalties and interest, or even worse, for abusing a tax shelter. And so, not to scare anyone, but that's the reality.
To your point, this is not something to be taken lightly on either side of that coin, right? To the person that wants to put their head in the sand and say, you know what, I don't even want to be concerned about it. I'm just going to overpay because I don't want to engage or, be responsible about learning the tax code and trying to determine what my legal amount is that I should pay. To the opposite side is that person, to your point, that is literally trying to figure out how to bury grandma in the backyard to save, like, ever paying any tax. Besides that strategy, Nate, of your grandmother being buried, which I'll look that one up after this. Let's start with the low-hanging fruit, right? One strategy that you're like, man, most entrepreneurs, business owners, investors either don't know about or they're improperly using, that is leaving money on the table, that you're just like, let's handle that right away.
Yeah, no doubt. So I'll give you three of the most common, if you will, the most common strategies. We'll start with the first one, and this is very common for business owners. They go to an accountant and they say, "Oh my goodness, you're formed as an LLC or you're a sole proprietorship. We need to make you an S Corp." Right? It's almost like the go-to, like, oh my God, you're going to save so much in taxes. Here's your S Corp election. We're going to form 2553, off to the races. And we'll see you in a year when I collect tons of dough for you. That's partially, yes. However, and again, let me just insert my disclaimer. Everything that I share with you, of course, talk to your tax professional, talk to your accounting professional. They'll know your own personal situation. They'll be able to guide you. And if they can't do it effectively, then look for other resources. And I'm sure we'll be able to point you to resources as well. These are complicated pieces. The tax code last time I checked was 6,870 pages. By comparison, the Bible is about 200 and it doesn't change. Imagine memorizing the whole Bible, right? And it doesn't change. Okay. And then if you add on top of that guidelines and publications, you're about 70,000 pages. So that's why we always want to make sure that an individual or a group assesses your personal situation. But to give you an overview, so this is one that's really big. S Corp election is great. So what the reason why S Corp election is a tax shelter is because as a sole proprietor or as a single member LLC or even as a partnership, self-employment tax is applicable to all net profit in most situations. Now, there's situations where it's not, and there's other, but we'll just go with the primary situation. What that means is, say, for example, you have 4 employees and they contribute to your net profit of $200,000. You labor for $60,000. You're going to pay self-employment tax in these with a single member LLC or a multi-member LLC, or even a sole proprietorship. You're going to pay self-employment tax on that full $160,000. Well, you didn't labor for $100,000 of it. You're still paying self-employment tax on it. Now, that self-employment tax is about 15%, 15.3%. So that's $15,000 you're paying in extra taxes. So this is where your accountant's going to look like a hero, right? For saving you $15,000 that year on your tax return. Now, here's part of the problem. Part of the problem is most accountants, God bless us, we throw a number out there and say, okay, well, here's your reasonable salary. You're required to take reasonable salary, as the IRS says. The IRS doesn't tell you how much it is or how to calculate it. They just say, go find a reasonable salary. So most, and someone listening today is like, yeah, that's me. They just throw a number out. Say, yeah, this sounds good. This is, maybe it's 10 grand, maybe it's 20 grand, maybe it's 30, maybe it's 40, maybe it's 50. I don't know what it is. Maybe it's 100. Maybe you're overpaying. And there's a lot of other factors here too. There's some factors on self-employment tax in terms of some benefits of the self-employment tax, as well as like retirement accounts, et cetera, et cetera. I won't go into all the nitty gritty. Like I could talk probably about a good 8 hours on each one of these. I can give a whole litany.
Yeah. It's hard because it's like a very specific scenario, but we hear that I should be an S Corp if I make 100 grand or more, or whatever the math is. And then you get into, there's all these other QBI deductions and things like that start to impact that, right? Like there's just so much detail there that I guess what you're saying is that sometimes we apply it incorrectly.
Correct. And not only incorrectly, sometimes we don't do the homework as well as have independently verified salary. So for example, what we do is we have an independent third party provide your wage as an owner. So we go through a test, if you will, a number of tests. We identify all the things you do in your company, all the things, your proficiency level, the amount of time, and we look at the Bureau of Labor Statistics and spit out a reasonable wage. And then that's an independently verified third party that's in compliance with the IRS. So if that's not happening right now, I would ask your accountant, hey, let's get more granular with this. Let's make sure that the reasonable compensation that I'm taking has been vetted and verified so that it is in compliance with the IRS. Because here's what's going to happen. If the IRS challenges your compensation and deems that it's inappropriate or unreasonable, they then may go back and they charge you interest and penalties for non-compliance of your wage. So that's really important. And this is, a compliance piece. It's also, nobody wants the headache of dealing with the IRS. Another part of this, guys, is that there's an abuse because I've seen people just don't take a salary at all sometimes. They just take they take the distributions. They say, oh my goodness, now I avoided everything. Well, that's back to what we were talking about, tax avoidance, perhaps even tax evasion. I had one year, I had someone and it didn't take them on as a client because they didn't take any salary. And they were the only person working in the business. So there's no way around you taking a salary if you're the only one working and you had net profit, right? There's just no defense against that.
You can't claim that you didn't do anything. I got a question for you around this. I want to know, like, as we are always trying to adopt new technologies into our space and not be afraid of them. So with this specific area, you talked about hiring a firm that's going to do the analysis to determine your proficiency and what the going rate of that person's wage would be. With the opportunity we have with AI now, that all data that is public out there is at our fingertips in seconds. If I decided to do this analysis using AI and I had the right prompts, assuming I had the right prompts, and I don't know what to ask it, but assuming I did, would that pass that test? And I printed that report out. I had the sources in which it validated, because I would imagine pretty quickly I could say, here's the hours I work in the business. Here's my level of expertise. Here's what I bring. What is the appropriate salary that I should pay myself, and give me the source proof to back it up. If I were to take that and print that, would that be documentation that you think that I could stand behind or no?
Indeed. Yeah. So with the system that we use, there are, I believe, 6 different sources that are pulled, which verify all of these parts. Now, granted, you'd need all the prompts, you need all the different pieces,
right? And
it's pretty comprehensive. However, if you were to build it, and you could certainly perform that test on an annual basis. Now, the time to build it versus the just paying a fee for a professional to do it, you just have to weigh that out. But AI is, and to your point, AI is a wonderful tool and I'm glad you brought it up, especially in the tax world. It's a wonderful tool if you know what you're doing. And here's where I'm going to go with this. We use AI in our firm to look up tax law, look up court case studies, and general guidelines. However, AI is not, let's just say it like this. I wouldn't hire AI as a full-time accountant yet. It makes a lot of mistakes, and they're rookie mistakes. And you wouldn't know it as if you were a non-practitioner. If you were just a taxpayer and you didn't have at minimum 10 years, honestly, I think the first 10 years is just kind of learning, getting your feet wet. The next 10 years is kind of figuring stuff out. And then the next 10 years, you finally got an idea of how to do this accounting thing. AI can be very dangerous, and it just makes a lot of mistakes. Even with, I've asked it to make calculations, and it'll pull data from 2023. It won't even tell me the year. And I'm like, well, that's not the current rate. Like, oh, sorry, I didn't know you wanted the current rate. Like, yeah, it kind of would be nice. And so you probably experienced this with AI as well for other research and whatnot, where you have to be extremely specific, and even when you are specific, it's not quite there yet. So caution, just definitely caution with AI. Now, it can look up case studies. It can look up court cases. It can look up IRS code. However, calculations are not always accurate.
All right. So thank you, Nate. I'm building a checklist. I'm listening to you. I'm a business owner. I'm an investor. First thing that's on my list is review my S Corp election with my professional. I'm looking at both the calculation of the salary. I'm looking at the cost savings of that versus my self-employment tax on the other side. Russ brought up the QBI deduction. I think that's something that a lot of entrepreneurs don't consider, that there's like a leveling, there's like a teeter-totter, if you will, of salary versus QBI deduction that people should have on this checklist. There was two other things that you said or like the low-hanging fruit you see all the time. I don't want to miss those before we move on to something else.
So the second one, and people hear about this all the time, they hear about, hey, I heard about this thing called the Augusta Rule. And I've a lot of people, especially in passive activities and different types of people who work from home or have meetings and whatnot. And they say, well, I'm not quite sure what this is. Well, it's worth discussing because it definitely can be low-hanging fruit, because every so often someone will have a meeting, they'll have a training, they'll have something that's business related in their home, and this is where the Augusta Rule may apply. And essentially, the Augusta Rule allows for up to 14 days of you using your home for business purposes and renting it out. So, for example, say you were going to rent a meeting space, but you said, hey, you know what? I'm just going to have the meeting at my residence instead of renting that space. Well, the business is utilizing your home residence now. And so there's a possibility to take advantage of this tax shelter to rent the space to your business. Essentially, for the first 14 days, it's totally tax-free. In other words, okay, well, that rental meeting space for whatever, 6 people is going to be $500. All right. So that $500, I'm going to charge myself in my primary residence. And then I'm going to have a business expense for it, except I won't have to claim the income up to the first 14 days. So you do the math on that and whatever that number is, but let's just use the $500. So $500 times 12, that's $6,000 plus another 2 days. So that's $7,000. $7,000 is eliminated from your income. So that's if you're at a 40% tax bracket, do the math. That's $4,100 or roughly there. What is that? $2,800, close to $3,000 in cash back to you. So powerful strategy. Again, check out the Augusta Rule and how to implement that. There's a number of requirements that go along with that, with documentation and agreement for the rental space, et cetera, et cetera.
There was nothing worse than walking into class when you're in school and the teacher saying, "Pop quiz day." Why? Because you were unprepared. Are you unprepared, though, for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
Tribe, if you're still searching for what is going to be that passive income source that's going to push you over the hump, it's going to help you become financially free, head over to the Art of Passive Income podcast, where our friend Mark Podolsky breaks down his amazing land flipping method.
You've heard us talk about how this one strategy has created over $30,000 a month in passive income for Russ and I. Do yourself a favor, wherever you listen to podcasts, go hit the subscribe button to the Art of Passive Income podcast today.
I know you're throwing out numbers as to try to be as generic as possible, right? But I have seen Augusta rules implemented, and people have said, hey, I went out and I had a third-party appraiser go and do an analysis. If I were to rent my house out and I used the square footage and I compared it to the venues near me that rent out their similar square footage, for instance, like, next to me, there's this great winery that does weddings, right? Yeah. And you go rent that property for 4 hours, they're going to charge you like $4,500. And it's like, oh, this property has this many acres, it has this many square feet in it, and my house has the same amount of square feet, has the same amount of acres. How do you look upon that as an accountant, someone that's helping advise the person there that says, hey, I'm going to rent my house out for $4,500? Because I could have taken my team, I could have taken and had the event I was going to do at that venue. Instead, I chose to use this location instead.
Love that question, Russ. So this is the question that comes up so often. Hey, what will pass the sniff test? Right? What works? And of course, people want to be compliant. They want to be able to have a position that's defendable. At the same time, they don't want to leave any money on the table. So it's a valid question. And so the IRS uses a test, and I'd like to share it because I think this is really important for your listener and your viewer, in that it's called the test that it assesses 3 areas of your deductions or your expenses. Okay. The first test, is it reasonable? Ordinary, necessary, and reasonable. So is it ordinary in your line of work to have a planning event? Okay, or some kind of workshop or whatever it is. Okay, so if the answer is yes, this is what we do, that's ordinary. Check the box. Is it necessary? Is the space necessary that you're using to do that kind of work? And if the answer is yes, then that's that. The third test, is it reasonable for the kind of work you do and the cost associated with it, right? So for example, let's just use, did I need to take a Learjet to that meeting when I went out to Virginia? So close, right? I could have just walked over there and instead of a fancy jet or Ubered, right? So the IRS may deem that unnecessary and unreasonable and disallow the deduction for that expense. And so that's our litmus test for and I think it's important for business owners to add this into their thinking and their vernacular on how they're making decisions in terms of their cost structure. So let's take the winery example. Okay, so they say the winery is like, 6,000 square feet. Hey, I got a big house, 6,000 square feet. All right, great. So then the IRS is going to say, so let me ask you this: are your guests using your whole house? Are they in your bedroom, in your bed? Are they using your private bath? Are they in your closet digging through your stuff, right? I mean, these are valid questions, right? So you're saying, hey.
So with the response that I like to be the debater of our group here. So if I was asking this question, if you were on my behalf, I'm just going to pretend I was the person sticking up for this hypothetical person doing this. I would say, well, I mean, I probably haven't walked into the utility closet at that winery either. I haven't gone into the kitchen of that winery either. I haven't, walked in every single bathroom and tried to make sure I went to the bathroom in every single bathroom inside of that winery either. Yep. Like how is that differentiated?
Let's do it. I love let's do it. So here I'll pretend that I'm the IRS. I've been in enough audits my lifetime, dude.
You ask me, I'll ask you.
I'm like Columbo here. So tell me. So here's the facility. The entire facility is the purpose of that entire facility is to enhance your experience, provide for your experience.
Yeah.
So that utility closet that houses those, those cleaning supplies, that's because it needs to be clean for your experience. So the IRS would then say, well, how does your home, your full square footage, your home, is it required for the enhancement of the experience of this engagement spend? So that's one context. But here's what I would come back and say. I'd say the best thing to do is to find a venue that you would have and use just comps, of course, for that venue. And if there's if there's a question mark on certain areas, just do math. Just reduce this, we can all do math. Reduce the square footage by what that looks like. Have your accountant jump in. So this is what we do. We actually, for our advanced tax strategy program, we do the work for our clients. We run the comps, we find the appropriate locations, and then we make the adjustments or reductions or increases based on the intended use and what the substantiability is for that deduction. And here's the fourth test, and it's not in the code like ordinary, necessary, and reasonable are, but it's just as important. Can you tell a good story? Does your defense tell a good? And I don't mean a fabricated story,
right?
But can you explain why this is ordinary, necessary, and reasonable in such a way that's compelling to substantiate?
Can I
legitimize?
Hold on one second. I want to ask one more thing, and I'll let you jump in there, Joey. So, staying in the, you're the auditor, and I'm trying to provide the reasonableness of this to you.
For a hypothetical situation you're talking.
Well, yeah. I mean, I'm just speaking on the behalf of the person listening, right? So we have a lot of people that are like us, right? That are business owners, who are investors, who are married, who have kids that are homeschooled, for instance, right? And at least in our families, right, our kids, I mean, Joey's on a trip in Virginia right next door to Missouri. By the way, Tribe, if you don't understand why we keep saying that, I made the mistake of telling Joey that Nate in Missouri was closer to Birmingham than he is to Joey in Virginia. And that was not true at all. But yeah, anyway, there's the joke. I'm an idiot. But so Joey's in Virginia right now on a trip, and his daughter's with him, right? Like our kids, our families are part of our business. They are our life, right? And a lot of times our wives are like, hey, by the way, I'm leaving, go do whatever. Your office is at our house. I feel comfortable leaving our kids here at the house. Now, if our team is coming over for an event, right, they're coming over to do planning and all the things, we're going to have a half day, and I'm in charge of the kids, me taking them up to, for instance, the winery is not going to be as safe, in my opinion, when I'm focused in on a meeting where maybe, we're only using a certain square footage of the building, but my kids are in that utility closet because they're left their own devices. They're out there riding the donkeys. They're doing whatever. They're hitchhiking. I don't know what they're doing if they're there.
What donkeys are we talking about? I don't.
Well, this winery has donkeys. So, okay. My point is that if they were here, right? Like, yes, they're in their rooms. They're using their bathrooms. Why would they use their bathrooms? Because it's more comfortable. It's more safe. I feel better about that. This allows my house to be used, in my opinion, in a way better than I would use that facility. But at the same time, I built the house in knowing that, man, I need to make it big enough to do these things. Otherwise, I can't. Like if I was in a little small environment, I wouldn't feel confident because I feel like now my business is encroaching on my family. So tell me, like, use your auditor defense there. Did I provide a good enough story? Reasonable? Or are you like still not getting there?
Still not convinced. So here's depends on the auditor. So I always say depends on the auditor. Now I'm gonna play a little tougher auditor. Okay. So this auditor says, well, now we're talking about child care facility, and so we're going to go into that realm, and so we're gonna separate the area that's used for business purposes, and we're gonna separate that from child care areas of the home. And unfortunately, child care doesn't apply to the Augusta Rule. However, if you have a bona fide child care deduction for your business where you reimburse your employees for childcare expenses, then we can talk about that on another day.
All right. So hypothetically, Russ, there's a change to the plan of whoever you're hypothetically talking about.
Yeah, no worries. Well, I mean, again, there's more reasonableness to this scenario, but we don't have time to go through all these. So we got three things that you're seeing most people made the mistake of: become a S Corp, Augusta Rule, and then
I'm gonna give you a third one. And I think as I prepare to tell you about the third one, I think this, even our mini debate conversation with the IRS is illustrative. It illustrates the complexity of some of these thought patterns with how we decide what we're going to take, what we're not going to take. I think it's important, just as important to consider that. And you say someone listening might be like, you know what, I don't really care. That's too deep of a rabbit hole. I'm just going to roll with what I got. And that's, just a certain level of risk aversion or thereof. However, again, that's why a professional is important, and your advocate on your side to help you in this space. The third one, you had mentioned the kids. So let's just take it there. So someone says, hey, my kids work for me and I want to pay the kids. This is a strategy that is important, especially if your family is involved in your business. If you're in passive real estate, for example, and you've got rental properties, and say you've got rehab work, and the kids were helping to clean up and do labor work, or they're putting signs in the yard, or you're taking photos with the kids in front of a property and saying family friendly, love to rent this property to you, you're putting on social, right? Hey, does that count? Do those count as paying our kids? And what's the benefit anyway? Well, let's start in reverse. The benefit of paying your kids for labor. And so we're talking about labor wages. Now, there's earned and unearned income. When unearned income has a much different tax scenario, after a certain small amount, it rolls right up to you as a taxpayer. So there's not really a whole lot of benefit in unearned income, but earned income is different. Earned income is a tax shifting in a way of your income off of your high tax books to zero tax for your kids. Of course, this year, 2025, I think it's $15,000. The first $15,000 in wage earnings is tax-free, federal tax-free and state tax-free in most states. And so in Social Security and Medicare, kids don't pay Social Security and Medicare until they're 18 if they're paid through a single member LLC or a partnership, aside from an S Corp. So if you have an S Corp, what we recommend is creating a separate LLC, a family management company, if you will, that's an intermediary. And so that's, again, a conversation with an accountant. So then what happens? Okay, now my kids have bona fide labor. I create a log. I pay them a reasonable income for the role and their level of expertise. Again, this goes back to identifying those amounts, but say it's $15 an hour, $20 an hour, whatever that looks like. And they're washing the company car. They're doing janitorial. They're maybe doing, kids today, like my kid, social media. Let me tell you, every time I put a podcast episode up, he's like, Dad, your podcast sucks. It's terrible. I'm like, well, help me, because you're the expert. You're Gen Z. Help. And so there's great opportunity with our kids to put them to work and for us to enjoy tax-free benefits of moving that money into their bucket out of ours. And there's a lot of other pieces to it, but that's one that people ask about constantly. And if it's done effectively, we can shift up to $15,000 per child off of our taxable income to theirs.
Well, and we've actually covered on separate podcasts about some of those parameters to consider, some of the, like you said, the reasonableness of what we're paying them for, things of that nature. So I don't want to necessarily dive super deep into that on today's show, but man, that if I'm, again, starting out on this journey of trying to be informed, trying to make wise choices to steward this aspect of my business and of my life, I now have a checklist. I can at least start with these three, and that's super great. I'm super grateful to hear that. I have one quick question before we wrap. And it's something that comes up pretty often when we talk to people, is the fear of audit, right? Mm-hmm. I know that all these things that we're talking about, it's not like nothing will ever be, never audited. And it's not like something will always provide an audit, but there's just this like looming fear, I think, in general. And I'm just curious, you've said you've been in a lot of these audits yourself over your career. What is it? Or can you just break down for somebody, what is that actually like? And what are the major concerns that somebody should be like making sure taking care of before something like that ever happened?
Yeah, that's a great question. So I get that a lot as well. Many entrepreneurs, maybe business owners, they don't have the time, the bandwidth, or the desire to be in an audit situation. Some do. And audits have decreased dramatically since the Obama administration, just because there were many cuts during his administration for tax audits. So we've seen a sharp decline. That doesn't mean it's sort of a wild, wild west and it's a free for all now and just woo-hoo, just deduct everything. Because they still do happen, and really it's a succession. Most people get a letter from the IRS; they think they're getting audited. Usually, it's an informational adjustment. Some kind of payer didn't get reported. It's all electronic. There's no actual human being involved in that process. It's just there's a mismatch with information. So don't freak out when you get the IRS letter. Oftentimes it is really just some information that perhaps didn't get sorted out, and your accountant firm can fix that. Now, when you have a true inquiry or examination, that's really what we call an audit. We don't even call them audits. They're called examinations. So internally, and simply an examination to substantiate records usually. So what does that mean? That's a part of the return that the IRS says, hey, you know what? We just like to get some more information to substantiate it, whether it be documentation, contracts, receipts, some kind of proof, and then we'll be on our merry way. That can be really scary because documentation, we're talking that usually happens a year to two, sometimes a little bit longer after you've had that expense or whatever it is. So it's super, super important. And I know entrepreneurs are notorious for this, and you know where I'm going, to keep your receipts, keep the documentation, substantiation, take pictures, do something to keep record of the activity that you've had. Oftentimes here, I'll give you some good news. In the audits we have been in, I would say minimum 80% have turned in the favor of the business owner, of the person reporting, because they kind of roll their sleeves up at that point. Like, well, now if I got to get involved with this, it's going to take my time. I got some other stuff I never deducted in the first place, and they'll go to town on that. And so that's how audit works. Every so often there is a random examination. So we just actually hadn't seen one in years. And again, hey, let's verify your mileage log. You can actually recreate one, and some other areas of that with a good team behind you and with the right records in front of you. You shouldn't have anything to worry about.
It's always been told to me that our job is to prove what has happened, right? It's hard for them to disprove what you can prove, but if you don't have those documents, then you don't have something to prove, and then they can decline as a result of that. Are there favorite apps that you suggest for people? I know, like Joey and I use QuickBooks, and we'll use the little snap receipt from it as we're doing stuff. Or are there other ones that you are fond of that we need to be thinking of?
Yep, those are great. QuickBooks, Snap Receipts, MileIQ. A lot of folks have gotten the different kinds of receipt scanners. So a neat receipt scanner and others are all very helpful, useful, and people are useful too. If you have a virtual assistant who can get the if you're just the kind of person who puts it in a folder, dump every receipt in a folder called 2025. And then just wrap it up in a bundle. You may never need to open it, but if you do, guess what? It's there. And for your listeners and your audience, I'll send you a checklist of 30 top core strategies for business owners as well. And they have summaries with each and every one of them so that you can share those with your community.
That's fantastic. We'll try. If you want to find out more, Nate has graciously given us a bunch of stuff. If you go to whatsaboutwallstreet.com/income tax center, we'll get as many of these resources on there as we possibly can. Nate, outside of that, if our listener wanted to connect with you, where would you send them?
Yeah, just send them to theincometaxcenter.com, theincometaxcenter.com. They can find us and get a hold of us, and we're happy to do some discovery and see how we can help.
All right. Well, Nate, thank you so much for coming on the show.
Thank you so much for having me.
All right, Tribe. I hope you found a couple of tax nuggets here. Obviously, we need to make sure that we're finding the backup, right? We need to test it. Is it ordinary? Is it necessary? Is it reasonable? And if so, can you document it and prove it? And are you a better debater than I am? All these things could help you save money in taxes and hopefully get closer to becoming financially free. Have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.